Hey everybody, and thanks for visiting me at blacklabelrealty.com for our real estate educational videos series. And today's topic is hard money. What is it? How do you get it? How do you use it? Let me first start out with explaining hard money and why you would use hard money. If you are looking for a property that needs extensive rehab, which is what we do, and you come across a property that, let's say, has a non-functioning kitchen and bathroom, had roof damage, water damage throughout the entire house, what have you. Your traditional banks are not going to finance that property. They want a property that is livable to finance, especially in today's market. So you need to buy that property with cash. Or have private loans, or use hard money. A hard money lender will lend money on the property, and they will also lend money for doing the repairs. So that's basically why you use hard money. And let me also say that hard money is a little bit of a misnomer. It's not that it's hard to get. In fact, hard money is actually easy to get. The reason why it's called hard money is the terms are harder than conventional financing. So, typically with conventional financing, you'll get a fixed rate, low percent interest rate in today's market. You might pay a percentage, or like 3/4 of a point or 2 points, somewhere along those lines in obtaining that mortgage. And when you do get that mortgage, you're borrowing a certain amount of money for a period of 30 years or 20 years or 15 years, and that's it. Hard money works in this sense. You pay points up front, you pay a percent on the money that you're borrowing, and the money that you're borrowing can be a dollar amount to purchase the property plus a separate dollar amount to do the renovations on the property. So for instance, you may pay 5 points and 14% interest on $100,000. And that $100,000 might be split up where $70,000 of it is being used in the acquisition of the property, and then $30,000 is being held in escrow for construction draws. And as you do the construction on the property, you draw down on that $30,000. So let's say that you're doing a kitchen, a bathroom, window replacements throughout the entire house, carpet, paint, some landscaping, maybe some roof repair. But it all totals up to $30,000. You borrow the initial $70,000 to purchase the house, you start your construction, and then as you get to a certain milestone in the construction, you call the hard money lender and say, I'm ready for my first draw. So then they send somebody out to inspect the property to make sure that what you had said is completed is actually complete. And then they will wire or send you a check, a certain amount of money for that first draw. That first draw, out of the $30,000, that first draw might be $10,000. Then you continue on with your rehab. You get to the second milestone and you do the same thing all over again, and you get your second draw. And then after the rehab is completely finished, you call up the hard money lender and you ask for the last draw. So they'll draw down that last amount. So at that point, you have fully tapped out the $100,000 that you borrowed from them. Now, keep in mind, you're paying your points. Typically, hard money works this way. You pay your points on the total dollar amount being lent, $100,000. You're paying, in this case, 5 points. That's $5,000 that's being paid up front. Also, you're paying your interest on the total amount of money that you're borrowing. So in this case, let's say I'm paying 14% or 15% interest on the money. Well, I'm paying that on $100,000, regardless of whether I drew down my construction draw. So that's how the mechanics of hard money work. Typically, a hard money loan will be for a short period of time. I see 6 months out there, pretty standard. And during that 6-month time frame, hard money lenders work a couple different ways, but you will either be making monthly interest-only payments during the 6 months, or some of them allow you to roll the interest into the loan, and it accrues on the back end. Now, because of the high interest rate and the short duration, it's imperative when you're using hard money that you rehab your property quickly and you have your exit strategy put into place and you execute on that exit strategy quickly. What I like to do is to buy property using hard money and do the renovations, get a tenant put in place, and do a refi on the property. This is for a property that I'll keep as a long-term hold property. And this way I can get my renovations done in 30 days. I can place my tenant, get my refi paperwork into the bank, get them a copy of the lease and everything else that they need, go through the refi process, and then pay. Once the refi is done, the hard money lender is paid off. And if you do things correctly, you are paying them off, and you might actually walk away from the table with a little bit of money. The banks are a little sticky with that in today's market. They don't want to see you walking away with a ton of cash, but they are still doing some cash out refis if it's minimal cash out.